Yeah, I think if you allow me a little historical context, in about 1972, there were probably about 23,400 banks. And when I tell people that number compared to today, and those are FDI insured, compared to today, there's probably about 5,800 banks, 5,900, depending on how you want to count it. But when you look at the average size of a bank back then in the early 70s, people are astounded when I say it was $25 million, $25 million in assets, and they were all making about a 1% ROAA. Now, that's phenomenal. So from that number, we have come down to 5,800 banks, basically, and to make a 1% ROAA for a bank at 25 million, 100 million, 200 million is extremely difficult. So I think any bank that is now in the community bank range of between 500 million and a billion, they have to get very aggressive in what they're doing to maintain high numbers. And I think that that's an historical perspective. I'm going to turn it over to Glenn. I'm going to follow up with him. But I want to make sure that everybody understands the historical perspective of what we're dealing with here. Because as we shrink down, and if you look at what the Fed is saying and the FDIC, that we're going to shrink down to 5,000 banks. And that's not like 20 years from now. That's like in 5 to 10 years from now. And that's a maximum number. That's going to be a lot of challenges for a lot of the banks, especially in the community bank arena.
Right. Every day I feel like I open my inbox and there's another transaction announcement.
I feel the same way.
It's almost like you're scared to open it.
That's right.
Who is it today?
Yes, that's right.
But then, Glenn, going back to you.
I mean, we're as an industry, we're at the point where you're either going to adapt or you're going to sell. There were, I think the number was 99,000 branches in this country. I mean, we could get down to some number that's like 50,000 because we don't need them. We don't need the overhead.
No.
I say to our folks all the time, we earn the right to exist in the market. When we fail to execute and perform, then we lose that right. And we may have to sell because we lose that right. So every day we have to figure out a way to execute, whether it be whatever ratio that you're looking at, because you could manage the bank to 100 different ratios. But at the end of the day, you need to perform and you need to adapt. You need to have the technology so that your customer base can access the bank without all these branches. And I always laugh because every time you look at a real estate development, it used to always have a bank pad. And you're like, guys, there's just not going to be that many bank pads out there. They're just not going to happen. They're going to be different. With your smartphone, you have a branch right there. You could make a deposit right here on the table and access your bank. So I think that the smart operators have already started to adapt. I think the less smart operators will go away. And I think that's just a normal process of any business, whether it be banking or just any business that's out there. You have to adapt and overcome.
I would also say that I think if the Tax Act had not been passed, you'd probably see mergers at a higher number than what they actually are today. I think a lot of banks, they saw what they were going to receive from the tax reform, and so with that they paused. And I think whether that comes back to the front table, the mergers that we're seeing today, I believe it would have been twice the number if the taxation had been exactly the same. But going from, call it 34% of a corporate tax down to 21, 22%, I think a lot of people pause. I think what they're not getting is that the normal just shifted with everybody. So if you were a high-performing bank to begin with, you're just a higher performing bank and the metric just looks like it moved up, but the new normal is still where the high-performing banks were. And I think we're going to see mergers actually increase a little bit more once everybody comes to the realization that normal is now normal. So what's a new normal for a high-performing bank? Maybe it's 1.40 ROAA. I don't know that yet.
Glenn, the change in the leasing accounting is going to change that again a little bit. So
That's
that
right.
new normal is going to have an adjustment. I mean, we own all of our locations,
Right.
but I don't know what you guys have done, whether you have leases because it got it off the balance sheet. All that stuff's coming on the balance sheet now, so all those calculations are going to be different in next year when you do that accounting.
That's correct.
Jeff, it looks like you want to say something.
No, I
What do
mean,
you have to comment about this?
Yeah, I agree with what people are saying, but, I mean, going from the number of banks back in the 70s or 80s, everything's gotten a lot more complex than it was then, too. In 1983, I think a call report was 24 pages. Now it's about 100, and regulation has certainly, filled in a lot of profitability gap. I mean, it's very expensive to be in the financial institution industry. But the other thing that you really have to consider is if you look at the space in payments, which going back to in the 1970s, I mean, we were a cash and check society, and it took at least minimum 7 days to clear a check from the East Coast to the West Coast. Now, things clear, countrywide and probably globally within microseconds. But the payments industry, we see the fintechs and we see fintech opportunities coming in to try to share our space. Payments is the third largest industry in this country. We have utilities as number one, lodging, hotels, the entertainment is number two, and payments is number three. And so there's a lot of room in there for competition, and I think one of the themes I've heard so far is certainly technology, and we play big in that space, and we try to work with fintechs so that we can at least have their deposits as they process payments for other people. But that's not going to go away. That's going to become a bigger and bigger part of what we do. And the Fed has tried over the last several years to facilitate payments for financial institutions looking at it. And unfortunately, it's been very, very unsuccessful, because what they've tried to do is to take antiquated systems like the ACH rails and continue to use that and try to come up with a new payment space where all of the fintechs are using mobile phone technology and cheapening the amount that it costs to pay somebody. Right now, the biggest deal in town is coming from the large banks, and it's actually made processing payments more expensive than when we paid with checks, when a bank cleared with checks. So there's absolutely zero efficiency there. That's probably the biggest disappointment I've seen in the study thus far. But having said that, we need to continue to look for efficiencies so that we can continue to play in the space, and certainly from community banks, I think we have an advantage with knowing our customers, with getting a lot more involved in the communities that we serve and live in and work in. So
Great. And then Leonard, do you have any comments off of this discussion?
Just a couple. As I mentioned during my opening comments, is Royals open to growth either through organic means or through merger? You have to do something. You literally can't just sit there and whittle away. We're lucky that at least we're in the Chicago market. When you look at the state of Illinois, I believe, my last look at the state of Illinois, I believe it had 417 charters, 417 banks, 150 of them roughly probably located in the Chicago market. Chicago's very competitive. But Royals open to continuing to grow by merger. Royals also open to increasing shareholder value through other means. In the meantime, we continue to be the community bank that we've always have been since its rebirth with the IPO in 2005. And being a realist, I know it's not going to last forever. But we're performing a great. We're lending within the communities. We're working with commercial type businesses. We are lending in the 1 to 4 family space. And we really realistically don't do anything crazy.
So to talk about consolidation in a broad lens, there's obviously there's trade-offs as you guys look at your own decisions, as other people do the same. So on one hand, and I'd just talk about this in general, on one hand you've got balance sheet. You have to be mindful of that, right? You're seeing a lot of deals that are being driven by companies with a lot of capital that are looking for low deposit costs so they can continue to make loans, obviously in this environment. On the other hand, I know at least Glenn and Jeff, if I remember correctly, you guys have seen some rather large deals announced in your markets recently. I mean, the WSFS beneficial deal for you, Union buying Access in your market. How does that give you guys a sense of, wait a minute, there's maybe more runway because there's a chance to go on offense and take some business and take clients away from other consolidators?
Yeah, I mean, the beneficial deal that you referenced on paper, I mean, beneficial should have been the acquirer. They did a conversion, they had all the capital in the world.
But they were, but Jerry Cuddy said, they were struggling to put that capital to work.
And they had this legacy franchise of locations that they had inherited from the old days that they just, I guess, couldn't figure out how to unwind. And it's basically like a marriage of two old school charters, kind of saying, let's have one of these old school charters survive. I mean, before that, WisFist buying Penn Liberty was a great community bank for a great community bank acquisition for us, because all the people that were part of Penn Liberty that was de novo. So now all of a sudden they're going to be part of an $8 billion bank or whatever it is at the end.
So you're seeing opportunity.
That's awesome for us because all those people are like, whoa, we we got in the back part of a train and now we're on the express going, we don't know where. That's good for small community bank growth. But yeah, I mean, you see some of these deals that you look at them, and there was just a deal where Citizens is buying Monument, and they're buying it to get in a different market, because they're in upper state central Pennsylvania, and it's an asset generation play, I think. So it's just interesting. I think I don't know that there's a handbook anymore to say this is the way the deal has to go. I think there's a comfort level that has to exist between the players to get something done. And I think the courtship period is much longer than it was, when you were trying to consolidate, 25,000 banks into 5,000. I think those deals, the less people that are out there now, I think those deals are harder to do. There's more issues that have to get overcome. And I think trust in our industry, trust in who you're talking to, is just a huge component of one of those deals being successful or not being successful, even if it looks good on paper.
Yeah, marrying the culture of two
absolutely.
different companies is it's a little bit tricky, and it's very difficult. And I think it's probably one of the less sexy things that you want to do when you're merging two institutions. But fortunately or unfortunately, it's probably the most important thing that you can do, because the customer feels that before anybody else does. And so I've seen mergers in the past that have been very successful because the people that are doing the acquisition really have thought it through. When First Virginia was around, I think they did it probably better than anybody back. And of course, there are a lot more banks to acquire in that period of time. But now it seems like people are so focused on achieving that efficiency because if you don't make back the acquisition in 4 years or under, it's a failure, and shareholders are a lot more sensitive to everything that's going on. I think they were always sensitive, but I think even more so now. But so it's the customer that gets the bad experience, and customers who are with community banks have a certain level of expectation of being able to reach who they want to reach, or being able to get achieved what they want to get achieved. And if you're not concerned about that, then you're probably not in a community bank to begin with. But so the opportunity for us arises when an acquisition goes wrong, and it can go wrong just by a little bit, or it can go wrong by a lot. But either way, it presents opportunities, and it presents opportunities both in getting really, really high quality people to come in and work for you, as well as getting wonderful, new customer relationships that we can, sort of really try to focus on. And like I said, some mergers go better than others, but every one of them, regardless, is going to present an opportunity for somebody.
And with Leonard just completing an acquisition, what are your thoughts on this topic?
It's definitely an opportunity. I was going to mention to Paul, we have Fifth Third Bank obviously buying MB Financial in our market. We recently had, was it First Midwest acquiring Standard Bank shares on the south side, who Royal competed with. Again, I look at it from the opportunity that my size is $425 million. I do want to get to $1 billion, hopefully at some point. There, in the Chicago market, there is this opening up of this gap occurring from the smaller size community bank with the personalized service, and then the very, very large banks. I mean, for me, MB Financial getting bought out by Fifth Third Bank, that came out of the blue. So there is a little bit of a blessing here in terms of there continues to be opportunity for community banks to continue to survive as some of this merger activity happens at a larger level. Again, but there's an awful lot of small banks in the Chicago market and in the state of Illinois that aren't going to be able to survive in terms of the compliance and the cost and just trying to keep some of those ratios up. If you're publicly traded, you either perform or you're going to have to move aside. And that's the lay of the land that I see on a going forward basis. But again, some of the large banks, some of the customers who have a loan that's just a little bit different, that's not going to fit into a Wintrust model, or that's not going to fit into a Fifth Third Bank model, we're here to do it. We're not going to do a silly deal. The deal's going to cash flow and it's going to fit within policy, but shaking the tree on the merger side, on the big banks, again, my opinion here, probably isn't a bad thing.
Great, no, that's great. So would you think that the consolidation is a good factor for growth, or kind of going back to the growth and opportunity pieces?
Personally, I think it's probably a little bit of both. I think some banks are going to get pushed out probably too soon or too early. But using my example here earlier, it can shake the tree for that middle market. So some of the smaller banks, us around this table here, can get some of that larger bank business that is going to shake down.